it's very easy to get lost in the detail, and what is vital that we don't lose sight of is the fact that the economics of development simply do not work right now. That costs exceed value, and therefore any development that is likely to take place is going to need some form of significant public sector subsidy, putting aside even the availability to raise finance. And that's going to be the real challenge that faces us probably over the next decade, because we talk about optimistically a return of the market. What you're seeing, the situation that you've just been discussing and describing, is simply the mechanism of mopping up carnage in the aftermath of one hell of a problem in the economic system. And all the circumstances that I know of that have preceded have been simply people trying to mitigate their loss. So the notion of kind of a return to profit, the notion of profitability in the sector, is an enormously long way off, because values, confidence have plummeted, and the reality is that construction costs, the historic land costs, all have to readjust to make the economics of construction work again without public sector subsidy. And so I think what we're seeing at the moment is there's the reaction to what has happened in the last 6 months, and there's probably enough there to kind of ease its way out over the next 18 months to 2 years. But the real question then is, what the hell do you do? Because the economics of development simply will not work without public sector subsidy. And we all know where and what is likely to happen in terms of public sector funding over the next few years. There are going to be major challenges ahead of us to actually restore that market to function properly.
What are you finding from your clients in terms of the options that they can look at from the developer's point of view, and they're coming to you saying it doesn't stack up?
Well, it comes down to gap funding, simple as that really. You can't move away from these fundamentals, therefore you have a gap. How's it going to be met? Who's going to meet it, and what are the criteria to get it? That's what it boils down to each and every time.
Banks aren't recognising the full adjustment that needs to be made to assets against which they have lent against. So, and that's a real frightening proposition. If they truly confronted the impact of the down valuation on their property loan book, then the trillions that they've had to date would seem inconsequential. So there are some you're right, there are some very fundamental issues about confronting the realities of the way in which the market has corrected itself, and whether there's a willingness and honesty out there in the financial markets and a preparedness to do that, because until we've reached that point, there won't be any activity, liquidity in the land transactions.
We're seeing a lot of clients that have properties to sell, but their expectations are just way above, and they're just basically saying, I'll wait for the market to return and I'll sit with what I've got. And yes, as long as that remains, we're not going anywhere. Interestingly, more or less the only people that have recently come back to the market are the likes of pension funds that are driven by financial parameters in terms of assets of property to other ratios of assets from property and other assets that they hold, and they're being forced to sell property to offload it off their books to convert it into other assets. But again, they're coming to the market looking to sell a property and they can't get the price that they want. Where do you go when people are sitting on assets they're not prepared to sell at the price that's currently being offered?